Good morning, everyone. Thanks for joining us for part 2 of DBRS Morningstar's 2021 Credit Outlook series. We're kicking things off today with our real estate panel discussion titled Clicks and Bricks, Industrial and Retail Real Estate Finding Equilibrium. I emphasize real estate in case you had any doubt why we're here today. My name is Chris Tiklis, and I'll be your moderator. I'm joined by 2 senior real estate professionals, Teresa Neto, Chief Financial Officer of Granite REIT, and Chi Tang, Senior Vice President and Chief Financial Officer of RioCan REIT. A few housekeeping items before we begin. I'd like to point out the Q&A box, which you can use to submit questions at any time. And we should have plenty of time at the end to answer your questions. I should also mention that the session is being recorded and will be available for replay if you so desire. I think that sets a pretty high bar for us, and we'll strive to be replay worthy. Now then, we'll start with, let's just go to the agenda. We'll start with some brief introductions. I'll provide a review of 2020 from the perspective of a credit analyst. Then we'll dive into our panel discussion. And in closing, I'll provide our 2021 outlook, and we'll wrap up with a Q&A period from the audience. Right, a brief intro from me. I'm Chris Tiklis. I joined the Real Estate Global Corporates team at DBRS Morningstar in September 2017. Our team covers REITs, REOCs, and pension plan related real estate entities. My background is in real estate and corporate finance, from a variety of perspectives, risk management, M&A, valuations, advisory, strategy, and so on. And with that, I will turn it over to our panelists to introduce themselves. We'll start with Teresa.
Good morning, everyone. Thanks for having me here today, Chris. I am Teresa Neto. I'm the CFO at Granite REIT. I joined in July of 2019. Granite is a pure play industrial REIT with a focus on modern distribution, logistics, and e-commerce assets. We have a market cap of 4.7 billion and assets of 6 billion. We own and operate 115 properties representing about 50 million square feet. And we're located in 8 countries, 6 in Europe, and then Canada and the US. And thanks for having me this morning.
Pleasure. Thanks, Teresa. Chi?
Good morning, everyone. Thanks for having me here, and it's a great honor to be on the panel with Teresa and Chris here. So I'm Chi. I'm the CFO of RioCan. So for RioCan is one of the regional and one of the largest REIT in Canada. We currently have about 15 billion book value, and we predominantly is in retail real estate. We're around, basically close to 91% in retail in terms of annualized revenue, has about 38 million square feet, increasingly mixed use assets, really covering all aspects from retail, office to residential. We currently actually have 4 large residential towers, and that component is going to grow over time. Development is certainly an important piece of our overall growth strategy. As you very much know, we're BBB rated by S&P and BBB high by DBRS. So again, great to be on this panel.
Great, thank you, Chi. And now with that, I'll provide a review of 2020, starting with a brief summary of our ratings universe. We rate all publicly rated REITs and REOCs in Canada and select issuers in the United States. Real estate asset class exposures predominantly consist of retail, office, industrial, multifamily, and seniors housing. Annual EBITDA of our rated entities ranges from approximately 70 million to over 3 billion in Canadian dollars. Ratings generally range from BB high to AA, which includes our pension plan related real estate entities. So just briefly, from our perspective, 2020 began with, I'd say, a fairly neutral credit outlook. We had some concerns, namely development risk, but it was fairly business as usual. While development risk was increasing, capital recycling was providing a key source of funds, portfolio quality was improving, and there was continued interest in unsecured borrowing. Then came a global pandemic. As we all know, COVID-19 has had a material impact on the real estate sector, as many places of in-person gathering were deemed non-essential, have been closed periodically since March, while at the same time, many of us have been living under stay-at-home orders, resulting in enormous economic fallout. At the same time, governments have pledged unprecedented support. And so what we've seen in our universe is a deterioration in key credit metrics, namely debt to EBITDA and EBITDA interest coverage, from a confluence of factors. Firstly, rent collections have been challenged, notwithstanding government support, which has been clearly negative on credit metrics. Pre-COVID, you'd expect rent collections to be 99.9% or better. And during the height of COVID and the uncertainty, it wouldn't be unusual to see some issuers collecting 70, 80% at the low points. At the same time, CapEx has been delayed or deferred, including development projects where sensible, which has been a positive from our perspective. Capital recycling transactions have been tempered, which has been a negative. In many cases, equity became prohibitively expensive, which is also a negative from the perspective of a credit analyst. Distribution policies have been reviewed and several cuts have been announced, which has been a positive, certainly depending on the use of proceeds. At the same time, there's been a heightened focus on access to liquidity, which is certainly positive if liquidity is available. However, at the same time, it can pressure metrics to the extent that far out future obligations are being pre-funded today, which just requires a little bit more work on our part to sort of understand sources and uses. So in terms of rating actions, so what impact has this had on our ratings? Negative factors have outweighed positives, which is evident in trend changes to negative, representing 23% of rating actions in 2020. And just by way of clarification, that 23% forms part of rating confirmations of 81%. Rating upgrades and downgrades in 2020 were due to structural features tying ratings to related entities or parent entities that whose ratings were upgraded or downgraded. And then under reviews have generally been event related. So we've talked about some of the shorter term impacts on credit metrics, but we're also mindful of a few key themes that may or may not impact longer term fundamentals. Some trends have seemingly been accelerated, such as e-commerce and onshoring, while some trends have been paused, at least for the time being, such as urbanization and experiential retail. We're hoping to explore these a little further during our panel discussion. I think with that, we'll get into our panel. I'll stop sharing the screen for the time being. Great. So now that we've set the stage, let's get started with our panel discussion. So I think this first question is for both of our panelists, and perhaps we'll ask Teresa to kick things off. So I guess we'd like to hear your perspective on how the business has been impacted by COVID. What has been learned to date, and how are businesses pivoting during the second wave? Thanks.
Yeah, so going into the pandemic, like every other company and every other REIT, we weren't quite sure what to expect coming into the pandemic. We didn't know how our tenants were going to be impacted. So we were watching very carefully, obviously, in those early months in March and April. fast forward now 11 months into this, I think Granite's business has done actually fairly well, actually very well through the pandemic. And a lot of that has to do with, one, our strategy, which is really to invest in e-commerce, logistics, and distribution assets. And as you know, that sector has performed very well during the pandemic. One of the key aspects was that our tenants were deemed essential. So by being essential, they were allowed to remain open through this period, and we were able to collect the rents. Early on, we did have a few tenants that were impacted and had to maybe slow down simply because of supply constraints, particularly when Asia was undergoing, they had the impact of the pandemic earlier, so that did impact some of the supply chain. That affected some of our tenants temporarily. But overall, they remained online, and we were able to collect rent. So we have a 100% rent collection track record through this past 11 months and through 2020. And as far as deferral requests, early on in April, we did receive only 17 requests. That represented less than 3% of our annual rent. When we dug in further into those requests, we realized they were just opportunistic requests from most of our tenants that continued to operate and certainly were well capitalized. We ended up just offering one deferral. It was short-lived. It was for a couple of months, and we collected that fully. So overall, I think we fared very well. I think as far as what we learned and observed was, one, obviously we're in the right business, and we've been focusing on the right assets for the past, since really the last 5 years. Granite's really been focusing on upgrading its portfolio towards the modern distribution assets, and I think that's proven to be very well. Credit quality is key. I think we've done an excellent job in underwriting our credits and our tenancies, and they have performed very, very well this year, and we continue to collect our rent, so that's important. And liquidity was very, very important. I think we definitely took advantage of the markets in 2020, and we raised over $1.6 billion in both debt and equity, and I think that became very important because, again, being ready for the unknown and not sure where this was going to be going, it was important to get ahead and to pre-fund really our business plan so that we can stay on track with our strategy.
Thanks, Teresa. Maybe we'll turn it over to Chi.
Thank you, Chris. So pandemic certainly have an impact on RioCan. And the extent, of course, as you can imagine, is certainly driven to some extent by the extent of closures required based on the government rules. But all in all, what we see is that, first of all, the impact is short term. We do not see a material long-term impact on our overall strategy. And over the years, certainly pre-pandemic, what we have done in terms of becoming 90% major market focus in Canada, about 52% from Toronto alone, as well as changing our property and tenant mix. For example, even though we're retail real estate, enclosed malls, which you could argue is kind of more harder hit by the pandemic because of the closure requirements, and that account for less than 10% of our total assets. And and of course, we have a large concentration in necessity tenants as well. So even with government rules and restrictions, and many of them are still open. So that's certainly tremendous help on our rent collection. These days, people kind of first thing come to mind is what's your rent collection? As you can see, what we certainly in a week, we're going to report year-end and Q4 results. But when they just based on Q3, you can see we're already for Q3, for example, when part of the certainly Q3 is more open and then things start closing, but still Q3 we achieved almost 94% rent collection. And for what we categorize into what we call strong, stable, and vulnerable tenants. And for the first two category alone, for example, they account for almost 75% of our asset base, most of them pretty much open, even under the current much stricter closure rules. And as of Q3, that category is on average 98% rent collection. So again, it speaks the volume. And Q4, frankly, we don't see material change from the Q3 results. So basically what we have done over the years in strengthening our property mix, tenant mix has really paid off. And of course, short term, there is the impact pandemic, undoubtedly. We're managing it very carefully, particularly from balancing that rent collection versus tenant relationship. And but overall, we don't see a material change. I know some of your question later on will address the impact on urbanization, e-commerce, so I'll wait until then to address those type of topic. In terms of development, yes, we do have a large development pipeline. Development account for about 10% of our total assets. That's pretty much the upper limit where we want to stay at, where we're permitted certainly 15. And throughout this whole pandemic, over the last number of months, pretty much most of our supermajority of our development are not impacted because they are considered essential construction project. They are residential mixed-use developments. So we don't see much of an impact there either. So again, pandemic certainly has an impact, but what we see is more shorter term impact.
Great, thanks for that, Chi. So yeah, as you alluded, we would like to get your perspective as well as Teresa's perspective on some of those key themes that may impact the business going forward. Maybe we can start with you, Chi. I guess, and you've sort of touched on it already, but you can also mention how these sort of themes impact RioCan's growing sort of mixed-use multifamily platform. I'll leave it to you.
Thank you, Chris. Well, all in, I mean, especially lately, I'm sure you've all read in the news, there's some headline news there saying that people are fleeing the urban centers and going to the suburbs. We do see some of that, no doubt, and the occupancy is also under some pressure. All in, however, what we see is we don't see material change on the assets we have. As I mentioned briefly, we currently have 4 large residential market, either stable residential towers, either already stabilized. These are new purpose built. We don't have older resi assets. And of course, we also have a number of condominium projects going on. They are located either both urban, like our Yorkville project, or suburban, like the Winfield Farm project. So we have a mix of both. We do see maybe shorter term, the pandemic does have a slight negative impact, you could argue, on occupancy and maybe rent, but very immaterial in our case from what I can see. And long term, but very importantly, we basically remain convinced this long term, the residential market, the need is still there. The reason being that if you look at the one key driver of residential rent growth and tighter occupancy, vacancy at resi level, is driven by population growth in Canada. As you very much know, Canada, at least based on pre-pandemic data, it's one of the highest population growth among the OECD countries. And part of the reason that drives that population growth is immigration. Certainly during the pandemic, because the travel restrictions, etc., immigration is much lower in 2020. However, in October 2020, for example, the federal government particularly came out and announced their immigration target for 2021 and beyond. The next 3 years, including 2021, averaging, I believe, around 411,000 immigrants, which represent about 30% higher than the pre-pandemic level. Right? And of course, we can argue, right now we're undergoing the second wave, a little more restriction. Who knows what might happen? There's certainly lots of uncertainties, but the intention of the federal government is there, right? So we believe Canada as a country is a big draw for immigrants, well-educated immigrants, and that's going to continue to drive basically the demands for residential real estate, whether it's through ownership, like the condominium or townhouse project we do, or through rental project. And then, of course, the second piece is on urbanization. We believe the human nature is we're social beings, right? And shorter term, I mean, you may say something, but I do strongly believe, and RioCan the business strongly believing that over long term, the urbanization trend is going to continue. And, so we remain certainly basically very much committed to our long-term development program, which is predominantly residential development. But of course, we'll assess project by project as always and be very careful on that commitment, for any new development start. But all in all, based on all the pre-sales we have done during the pandemic, we continue to do well on pre-leasing. Like if you recall, we have a Brio, which is our new residential rental tower in Calgary. We literally finished the construction right at the onset of the pandemic in late March. And of course, as scheduled, we have to launch it. And so we literally launched a residential new rental building in the middle of the pandemic and in Calgary market, right? When the oil and gas is also under pressure. I mean, as you could see in our Q3 disclosure, we already, despite that, we make tremendous progress on the rental leasing. And next week, it'll come out. I can at least anecdotally say we continue to make great strides on rental leasing on that property in the middle of pandemic in Calgary market. So that speaks still about the location of the assets, right? And because that one particularly is very well located, close to universities, close to hospitals, etc. So again, we still focus on predominantly on the long-term nature. And another thing I think I forgot to mention, in addition to immigration, another driver, don't forget, is student population, international student population. That's going to be added on top of the 400,000 also annual immigration target, the federal government target. So that's going to, in our mind, continue to drive the long-term growth and demand for residential rental, as well as other ownership form like condominium townhouses.
That's great. No, that's great information. Thanks for that, Chi. And then I'd like to turn it back over to Teresa to get Teresa's opinion on some of those key themes. I mean, ones that seem most relevant for Granite are e-commerce and onshoring, if that's impacting the business at all.
Yes, sure. I'm definitely on side with Chi when it comes to immigration. I mean, immigration for sure. We've had a slowdown, obviously, because of the pandemic. But once it comes back on track, and we're getting 400,000 more coming into Canada, and predominantly in the urban centers, that also bodes well for our business and the e-commerce and distribution business, because that creates demand, and that will mean a demand then for the warehouses. So we think that's going to continue also as one of the positive aspects and tailwinds for the industrial business. But by far, obviously, the story this year has been e-commerce, and there's no doubt that e-commerce is having a huge impact on the demand for industrial space. It's probably accounting for like 45 to 50% of the demand today. So when you look at, and I was looking at some, e-commerce penetration numbers, and it really has been an astonishing year. So last year in Canada, at the beginning of last year, I think e-commerce penetration was something like 3.8%. And when I looked at preliminary numbers in November, it was more than double. It's 7.7%. In the US, same phenomena. So, ending 2019, they had e-commerce penetration of retail sales of about 11%. That's now hitting 15%. And there's many predictions that saying that, in the US, e-commerce penetration is going to be 20% by 2024 and even 30% by 2030. And we do have other markets where we can look to where that has happened. So in the UK, e-commerce penetration is already well above 21% at the beginning of last year. So I'm sure that's closer to 30% this year. So the question is, how much of that is really, that is obviously a phenomenon because of our stay-at-home requirements and the need to do online shopping. But are we creating habits that are going to stick? And I think the answer is yes, maybe not to the same degree that we're seeing because people are forced to be in their homes right now. But I think we're creating consumer habits. And the consumer is now getting used to buying and shopping online. And actually, it's really interesting. So RBC, they do an annual survey. They've done their third one this year, came out with on e-commerce in Canada. And it's really astonishing that well over almost 90% of respondents have done some type of level of online shopping. So that's quite a significant amount. And more astonishing is about 90% of them have hit an Amazon website and purchased something. So the conversion rate is very high when we're online shopping. So we're creating habits, and our expectations are changing. It's not, before 2 years ago, I would have put up with a week or 2 weeks delivery. Now I want it the next day. And Prime certainly is making that available to me. So it's not just the consumer too, but it's also the retailers. So retailers, obviously Amazon started to focus on Canada about 3-4 years ago. They've been establishing their network, leasing massive fulfillment centers, setting up their network in Canada, and that has driven other retailers to follow and to look at their offerings. So Walmart, and even food retail. So food retail is there's been a lot of investment on grocery delivery. So all those investments eventually, they are preparing, and retailers are getting ready for their multi-channel offerings. So not just bricks and mortar, but e-commerce is going to be part of their offering. And I think that's what's creating a longer term effect that will continue to benefit the industrial and certainly distribution warehousing assets like we're invested in at Granite REIT. So it's really creating those habits. And again, like I mentioned, the immigration is certainly going to help as we continue to have growth in Canada, growth from population. We will continue to see that demand as well. So I think we've got a couple of things going on. You did mention about onshoring. I agree. That's also another trend that we're seeing. So clearly, when we entered the pandemic, there was a shortage of supply that created some slowdowns or shutdowns, certainly on the manufacturing side. We saw the empty shelves as we went to our retail outlets. So it did expose the need that the just-in-time inventory that we adopted many years ago didn't work. It didn't work and it failed. And I think that has made retailers and distributors rethink their inventory levels. And in fact, inventory levels, certainly in the US, and I think we can extend this to Canada, they're actually below the 5-year average. So they still haven't caught up to, regular inventory levels. So we're going to continue to see those inventory levels increase as we get back to normal levels. Plus, based on just anecdotal evidence, about 5 to 10% more inventory will be carried simply for that onshoring, just in case type inventory. And the last aspect is the political impact. So there's there could be a political impact from onshoring, and that, look at Biden with his Buy America, so that you're going to see more manufactured in your country. Even Canada talking about manufacturing the vaccine, so they're not relying on, Europe for that. So you'll see a little bit more potentially manufacturing and political will to have products being made in country, and therefore requiring more warehouse space locally to manage that. So I think those two are definitely themes we've seen through this year.
Mm-hmm. Great, thanks for that, Teresa. I think the next question, which I think would be interesting to hear you both sort of opine on, I think you've kind of touched on it already, but maybe asking it in a bit of a different way or sort of more directly, but it's sort of to do with what does the future hold? At what point does the market for retail and industrial real estate reach sort of equilibrium? And what does that look like in terms of, new supply for industrial, demand, rents? Will industrial rents continue increasing to reach a point where they're on par with retail rents? Will we see more last mile distribution from urban locations? And then what are some of the risks, and I guess what's being done to mitigate those risks on this path? And maybe we can start with Teresa.
Yeah, so it's a good question. I mean, I guess at some point there will be an equilibrium, because we are going to figure out, I think e-commerce is here for a while, and online shopping is going to see a continued, increase for quite some years. And I can say that certainly for Canada, simply because we're behind the US, we're behind the UK and Asia. So we know penetration levels have a long way to go. At 8%, we know we can get to 30 which is where the US is heading. The UK is practically there. So we know there's many, many years to come where we're still going to develop our online shopping capability. So that will continue to create demand. And as far as like Canada, I mean, in the major markets, we're land constrained. So Toronto, Vancouver, Montreal, those have availability rates of below 2%. So there's continued demand for industrial space. Where land constrained, developable land is few and far between, and they're in few hands. So I think that alone will continue to drive rent. And we've seen rent increases. Overall Canada average rent now for industrial is close to 10%. Vancouver is just on the verge of hitting $14 per square foot. And they've had 9 years of rent increases in Vancouver. Toronto saw rent increases of 19% in the industrial space. So there's still some room to go when you look at Toronto sitting around 10, Vancouver, which is even far more land constrained, perhaps you can argue, and they're, $4 heavier. So I think we have some room on rent increases. Are they going to get into the $30, $40 rents? Time will tell. I think, we can look to other markets for that. I think one thing to remember too is rent itself, from a distribution perspective, represents a small portion of the total cost of a 3PL or a distribution or e-commerce house. The majority of the cost is in labor and transportation, and so there's a lot of room to grow when it comes to the rent side without impacting their operating expenses significantly. We talked about, the demand for infill locations. Will that change? I think you might see a little bit of that. I think there's a lot more discussion in the US about repositioning certain assets for more of an e-commerce or last mile type of use. And I think we might see a little bit of that, but I don't think that's going to solve the demand issue fully. It'll create some supply, but I don't think that's going to solve the largest supply requirements that we're continuing to see. So I think for a while, I think we have a long way to go. But I guess at some point, yes, the retailers are going to figure out, just how much bricks and mortar they need. They'll figure out their multi-channel offerings, including e-commerce. And at that point, I think we're going to see that equilibrium take place. When? Okay. I don't know. Yeah.
Thanks, Teresa. And then I guess just one concern I think might be, you kind of touched on it a little bit again in terms of land constraints and, limited availability of supply. I guess kind of asking it sort of more directly, is there a risk of oversupply in key markets? And then what can Granite do to, mitigate that risk?
I think when it comes to the Canadian larger markets in Canada, I think that risk is quite mitigated. So even this year, we saw a fair bit of supply come onto the market, but we still had well over 18 million square feet of positive net absorption. So the demand is still ahead of the supply. I think in the US, you're right, we do operate in a couple of markets where supply is less constrained, land costs are lower than they are in Canada. And so you do have to be a little bit careful about, watching that and watching the supply. In those markets where what we focus on and what we do is we look for the best locations within specific industrial and distribution nodes. So as opposed to being in the outer skirts, we look for assets in key distribution nodes that are near infrastructure. So the highways and the ports and the intermodal rail systems. That's important because that's going to be, and also looking for modern product. Because e-commerce demands, newer, higher buildings, more door docks, more space for parking, et cetera, and truck parking. So looking for the right assets, modern distribution assets, and also looking for the right location is key. And I think one thing about the industrial market, you're right, sometimes you'll see oversupply, so you might see it somewhere like Atlanta or Dallas. But the good thing about industrial is it adapts fairly quickly. It starts to slow down rental increases, and then automatically the supply starts to slow down until you reach equilibrium again, and then it creates demand, and then you might see a cycle again where you'll see supply move up and down. So I think it's been a rather disciplined market overall for the last 20 years, and it'll continue to do so in our view.
Okay, great. Thanks, Teresa. Then I guess, so turning it back to Chi, I guess similar question for you, Chi, but I guess through a retail-focused lens. I guess some thoughts come to mind. Will retail assets bounce back post-COVID? What does resilient retail real estate look like beyond COVID? What is the future for enclosed shopping centers? Will some retail properties need to be repurposed? If so, for what uses? And I guess to the extent that RioCan is contemplating any sort of major projects, I guess where will the funding come from? few questions in there, but
for sure, that's definitely quite a few questions there. So for retail real estate, right, and part of it actually, frankly, even what Teresa have already touched on also impact retail real estate, because even though we may be focused on different components of the real estate market, but there's a relationship, because your industrial usage demand is driven of partly driven as quite extent from retailers, right? And we rent spaces to retailers. And so what we see is over long term for retail real estate, we do think, well, first of all, I should emphasize that in Canada, there's no such what we call structural vacancies like what you may see in the US in certain regions, where literally a large mall was abandoned, huge amount of vacancies available. Like in Canada, you don't see that. Not only you saw, strong occupancy and leasing, throughout the pandemic, even among not just, by RioCan, but also by our retail real estate peers as well, right? So there is not a huge vacancy. Like for us, for example, even as of Q3, amid the pandemic, we're over 96% occupied overall, right? That's for retail. Again, it speaks volume about the quality of the assets, property mix, and all that stuff, as I mentioned earlier. But again, it's quite you saw that in other real estate company, retail real estate REITs as well. What that means, what we see is that over time, with the population growth in Canada, as Teresa and I both touched on earlier, through mainly driven by immigration, what we see is retail is going to transform, right? It's already even pre-pandemic, no doubt about that. That is, the retail per capita is going to drop, in our view, over time, but not necessarily total supply. But so as the basic population growth is going to outpace that supply. So what that means is the retail real estate, in our view, what we call become more efficient, right? Because it's transforming its usage. Even just use the example, grocery store as the example. I mean, many of us do, click and collect, right? So what they do is they, designate a portion of their store for that purpose. It doesn't mean that returning leases back to us or space back to us, but they are changing the usage of the same square footage, how they allocate the usage. And of course, they are changing their product mix, more fresh food offerings. So the nature of the real estate is transforming even pre-pandemic. And of course, because of the pandemic, it accelerates some of the trend. We all know in the pre-pandemic world, fashion, especially mid-level fashion, is under lots of pressure, right? And pandemic, of course, accelerate some of that. You saw some of the bankruptcy filings, pretty much all fashion-related retailers, right? So to some extent, those trends got accelerated. However, in terms of magnitude, it's still fairly small. Like in our case, like what we disclosed, of all the bankruptcies in Canada, only affect our annualized income by about less than 1%. Right? So again, retail is transforming itself. The usage become much more efficient. And of course, as Teresa touched on when he talked about, industrial real estate, that is e-commerce, of course, right now usage is elevated, penetration is elevated because of pure necessity. We all need to order, but store is not open. You have to go online, right? And would that level penetration stay at the same level post the pandemic? I'm actually well of the same view as Teresa touched on. We don't think it will be the same level. However, it will not be dropped back to the pre-pandemic level. It'll be somewhere in between, right? So penetration of the e-commerce will continue to stay. And so the question is how we as retail real estate, together with our tenants, retailers, how to adapt our real estate usage to better fit the customer needs, right? And so that transformation is already going on. And with the pandemic, it certainly highlight the importance of to retailers that they, basically you need both means, right? You need brick and mortar because people do want to go shop, people are social gatherings, but you also need that e-commerce platform. The best is the two combined, right? And how do you manage? So all the retailers are trying to figure out where they are certainly to support them, right? But all in all, we do think over longer term, retail real estate is going to become more efficient. And for us, because we do have with predominant retail real estate, part of that transformation, again, this happened even before pre-pandemic, is how do we utilize these great real estate space, retail space, or the parking lots people talk about, right? And how do we do it? And the question very much often depends on assets, of course, is we intensify into mixed use residential development. Fairly often, we literally just a corner or discrete part of our shopping center, and we could develop into multi-level residential buildings. We've done it before, and we continue to do so. So that's also part of transforming retail real estate into alternative usage, right? And maximize the value to unit holders. And of course, for many of our shopping centers, very urban location, well-transit oriented locations, and it also serves to quite extent the last mile distribution centers. They may not be called that, but it's essentially serve that function. And we think that element is going to grow through all the retailers, develop that module between, basically omni-channel click and collect model. And we are also looking at even from a technology perspective, because there's technology instead of the large big distribution centers, because many of our well-located urban centers, like those mini distribution centers, right? There's technology there, which was actually in talks with some different company to assess whether it's something we should look further. Again, depend on location, of course. So really, it's a matter of just really look at the market trend, look at what's the long-term impact, certainly short-term impact as well to adapt our real estate. And residential real estate, of course, there is a big, relatively speaking, a much bigger gap between supply and demand, right? That's why the resi is, we believe in the long-term future of residential development and residential real estate. We'll continue to have more and more of that. So I hope I cover all your questions.
Yeah, just about. And I think looks like I don't think we received any questions yet, so we have a bit more time. And so maybe we can just ask sort of a wrap-up question, and we can start with Chi. And I think you touched on a lot of this already, but I guess give you an opportunity to add anything. So how are each of the panelist businesses positioning for success in light of the current environment and beyond? And then most importantly, how will unsecured debt continue to fit into your strategy and indeed facilitate your business strategy? And so turn it over to you, Chi.
Well, thank you. Certainly unsecured debt market will continue to be a key source of funding source for us. And we currently have almost 60% of our debt portfolio actually in unsecured, right? So we'll roughly kind of maintain that level, maybe not precise. Last year, as you know, we did 2 green bonds. And so we really managed under the overall, balancing between leverage, that EBITDA, of course, but really utilize the unsecured market. For us, because of we're tapping more and more, get more and more involved in the residential real estate market. So there is certainly also the cheaper CMC secured financing available to us, right? So that component, we do expect to continue to maximize it. And with certainly pandemic going on, with us also doing development, assets recycling, managing the capital structure, is certainly very key to us. Throughout the year, we make sure, especially under the pandemic, maintain very strong liquidity. We make sure our liquidity stay in that 800 to $1 billion range throughout this whole period. just as a precaution measure, of course. By doing, but we also have a lot, because we have a very large unencumbered assets pool, like almost 9 billion assets unencumbered. So it gives us the flexibility, because we could put on some secured mortgages or CMHC financing in relevant cases, and then really free up the line of credit utilization to enhance that liquidity situation, of course. So really, we look at all these all combined, and of course, we continue to recycle assets, right? Our recent, once we finish the secondary market assets disposition program, almost 2 billion program, about a year ago, we finished it in 2019. We certainly don't do that large scale disposition, but every year 300 or 400 million, that's kind of our norm, even in the pre-pandemic world. During the pandemic, we're able to secure fairly similar range. Disposition may not be all closed during the year, but pretty much similar level. So that's part of the capital financing, of course, to fund our development program, to maintain the overall debt EBITDA in a reasonable range. So really, we balance all these factors to make sure we keep an eye on the growth factor, but of course, the balance sheet strength is ultimately importance to us as well.
Thanks, Chi. Turn it over to Teresa.
Yeah, so for 2021, I mean, I think for Granite, it's really staying on course with our strategy, and that is still to continue to grow and to continue to focus on, the modern distribution e-commerce assets that will be remain our focus in our key markets, which will be in the US and Toronto, and particularly Netherlands and hopefully Germany. We like the unsecured market. We did tap in last year for $1 billion. I think the unsecured markets definitely gives us the flexibility that we need. 100% of our debt is unsecured, so we don't typically tap into the mortgage market, but it's good to know that it's available, because all of our 6 billion assets are unsecured at this time. But I think it'll be more continued focus on the same strategy, where we looked at tenant credit as we underwrote those $1 billion of assets last year. That's very key. Focus on property management, staying in touch with our tenants' operations. What are they up to? Are they continuing to operate? How are they being impacted as we continue to live through this pandemic? Another aspect too, I mean, there's no doubt there's a lot of focus and a lot of capital flow, new capital flow moving into the industrial sector. This has impacted cap rates, definitely in the markets that we're in, at least 50 basis points. And so markets that were in, low 5% are now in the low 4s or mid 4s. But given where cost of borrowing is, it still makes a lot of sense, certainly in the private equity space. So we're seeing a lot more activity and a lot more competition. So that's where our platforms are going to be key. Relationships are going to be key. And I have to say, we do have a platform in the US. We have a team in Dallas. We have a team as well in the Netherlands and Amsterdam. And that was actually quite critical during the pandemic with a lot of the travel restrictions. What traditionally would have normally been done out of Toronto, we now had people on the feet on the street that actually could continue to look for product and look for growth. And that's going to be important too, to continue to enhance those platforms in our regional offices. And probably the last thing too, just like everyone else, is we've been focused on technology, and so that we're able to continue to be efficient and to be nimble as we transform our business and transform our platform with our global offices. So it's really a continue to stay the course, stay focused on the types of product that we want and we want to buy, and leverage our relationships so that we continue to grow.
Great. Thank you, Teresa. So I think that just about wraps up our sort of formal panel discussion. Just remind our audience that please feel free to send in questions. I think, before we get there, just thank you again to Teresa and Chi for participating in that very enlightening panel discussion. And I think before we get to the Q&A, we'd like to close with our credit outlook for 2021. Admittedly, our outlook is moderately negative, given the number of negative trends we have out there at this time that will need to be resolved likely in 2021. However, there are a number of moving parts, and we'll mention a few here. Let me just share my screen. Sorry, bear with me. So industrial real estate tailwinds, I think we're of the view that they're likely to continue for the time being, most significantly as a result of increased e-commerce penetration and corresponding increased demand for distribution and logistics, along with other more recent considerations such as occupiers storing more just-in-case inventory, as Teresa mentioned. While COVID has been tough on retail, we'd emphasize that not all retail real estate is created equal. Necessity-based retail continues to demonstrate resilience to e-commerce competition, although it might take some time for demand drivers to recover in population-dense COVID hotspots, in our view, which they did provide growth pre-COVID. I think we're hopeful with the rollout of vaccines and a normalizing economy, which should lead to acceleration in transaction activity, improving rent collections, and we're also the view that issuers will continue to prudently execute intensification projects, therefore upgrading and diversifying their portfolio mix, which can help to mitigate some of the risks we've identified through mixed-use projects, incorporating uses such as multifamily, which has been an area of strength. So I guess I would just say in summary, while we do have a moderately negative outlook, we do anticipate some modest improvement in credit metrics from the lows of 2020 as the economy continues to normalize, which is already incorporated into our ratings, I might add. However, we'll continue to monitor our issuers for improvement or further deterioration in credit metrics relative to our expectations. So I think I'll stop sharing my screen. Just check if we received any questions. So we do have a question here for Chi. The question is, how is the second wave affecting occupancy and rent collection?
Well, good question. I think that's on top of everyone's mind, especially for retail real estate, I have to admit. I mean, as you can imagine, because we're releasing results in 1 week, I cannot get into too much detail, so I can just give you some indication in general. I think certainly right now, especially I think in late November, particularly in Ontario, given our large concentration of assets in Ontario, things start getting shut down, right? And then, of course, right after year-end, even more restrictive measures implemented in Ontario, for example. But what we see, we're actually very pleasantly surprised almost to some extent, because, naturally you saw with more closures, some tenants, even if they have the capability to pay, maybe they'll hug that cash and then don't pay us, right? So it's more, and we're actually very pleased to see the results, the rent collection we're seeing, and a large chunk of our tenants are actually still open because of that necessity-based tenant base we have. So we actually, second wave, certainly it does create some uncertainties, but in general, we're actually holding on very nicely. And then you will see basically in a week in terms of our occupancy, we're basically doing better than what we expected early on.
Okay, great. Thanks, Chi. And then maybe we have time for one more question for both panelists. This individual is looking for a perspective on what is the market for asset recycling like currently. Maybe we can start with Chi, and then we'll turn it back over to Teresa for final words.
Sure, thank you. Certainly, in general, we all know 2020 or even now is relatively less active market, right? Less transactions in general. However, there's still transactions going on. Like as I mentioned earlier, in our case, we were still able to secure, like pretty much, for example, in Q3 when we announced, in addition to over 100 million disposition already closed, we have almost another 300 million under firm or conditional deals. right? So all in is still in that 400 million, and we still achieve very good cap rate. For example, the East Central disposition, 50% disposition we did, partial interest, really, we achieved like 3.5% cap rate on residential real estate, right? So pretty much similar to the pre-pandemic level. What you see is because many people just like us have confidence in the long-term future of our assets, right? And there may be buyers out there who want to thought they can take advantage of the market and want to, lower the price. But the truth is, because of the strong financial situation, many of us like RealCan, the strong liquidity we have, we don't have to sell, right? So that's partly why you don't see many transactions. And I can tell you, we still have people approach us, even for some of the remaining secondary market assets we have. So the market is definitely not dead, but certainly lower volume. And we're being picky, and of course, also stay on our foot as to the pricing we want to achieve as well.
Thanks, Chi. Turn it over to Teresa.
Yeah, so as far as Granite, we really haven't had a large disposition program. In 2019, we did about 100 million. Last year, probably around 50 million. And really, that was just a focus on disposing some of our magnet-tenanted properties in, I'll call, non-core markets. So some in the US, which we disposed in 2018 and 19. And last year, we sold a couple of smaller Magna properties outside of the GTA, so St. Catharines and Windsor, and a property in Spain, and that was our only property in Spain. So again, it's more a focus on moving our portfolio away from manufacturing and towards the modern distribution product. But there is a lot of activity, certainly in the US. And we're starting to see more activity in Europe, in Germany, and the Netherlands. Because there's a lot of capital flow moving to the industrial asset class, there are transactions occurring, and cap rates are definitely falling. So it's a matter of whether or not we're obviously not disposing our modern product, and we are not planning to do so because those are our core product moving forward. But there's definitely heavy transactions, certainly in all the key 50 markets of the US, and little less so in Toronto. Toronto is a little bit slower, fewer transactions occurring, simply because industrial landowners are holding on to their assets. So, but the market's definitely come back following the pandemic, where we're back to pre-pandemic levels, and I'd say even more interest really from private equity side in the US on industrial assets.
Great. Thank you very much, Teresa. So yeah, I would just say on behalf of DBRS Morningstar, myself, the entire real estate team, thank you again very much to Chi and Teresa for participating in our panel. And thank you as well to our audience for your time. Hope you enjoy the rest of your day.